QuickBooks Pro Plus Desktop 2022 Presentation Sales Receipt Form. Get ready because we bookkeeping pros are moving up the hilltop with QuickBooks Pro Desktop 2022. Here we are in our free QuickBooks sample file, sample rock castle construction, going through the setup process, selecting the view dropdown, the open windows list, open windows on the left-hand side, going to the company dropdown, home page, opening up the home page in the middle, maximizing the home page, then going to the reports dropdown to open up the major financial statements, company and financial, moving on down to that balance sheet standard report, keeping the date range where it's at. Going to the reports drop down again, reports drop down, company and financial. This time open up the P&L, profit and loss, otherwise known as the income statement. Changing the first date to January. There we have it. Let's go on back to the home page, which is in the open windows on the left-hand side. I'm going to collapse the item up top. We're focusing on the customer cycle, which is going to be, you can call it the accounts receivable cycle, the sales cycle. In prior presentations, we focused in essence, the full accrual process where we do the work first, bill the client with what we call an invoice, and then we're going to receive the payment, which might then go into undeposited funds, then make the deposit. However, what if we are in the type of industry where we're going to do the work at the same point in time we get the payment? In that case, we're going to be more on a cash basis system. And if we any kind of system where you're imagining, like a check register, or you're recording the payments at the point in time that you are receiving them in QuickBooks, and especially if you're getting cash payments, for example, you're typically thinking of the create sales receipts. Now that's a cash basis system generally because you're getting paid at the same point in time the work is done, like a restaurant or a food truck or anything where the cash register generally would typically be. That's still a step away from basically depending on the bank itself, bank transactions, which could be bank feed transactions in order to create the bookkeeping system. For example, in other words, if you had like gig work or something like that without a system where you're getting the money at a cash register, but for example, you're just getting money from platforms that are going depositing directly into your checking account transactions, you might say, I don't need to create a sales receipt. I just want to go right to the deposit. And I'm even going to wait till it clears the bank and then look at my bank statement or take the bank feeds and deposit it in as I receive them, increasing the checking account, and the other side then going to revenue, increasing on the revenue side of things. Again, that's a step away from even a cash basis system because you don't have that double check between us entering the data and then it clearing the bank, but that could be appropriate in certain circumstances. Anywhere where you're receiving cash and you're getting multiple kind of payments, especially in cash, and then you're choosing to go to the bank, you have to go to the bank, for example, group that cash in a different format than you had received it and deposit it into the bank, then you're probably going to be using this sales receipt type of format for multiple reasons. One is that you want to record the transaction at the point in time it was made. Two, you want to track the information from the customers that you have received it in so that you can go back and find those customers more easily, which might not be something you could do as easily if you wait for something to clear the bank, although sometimes with electronic transfers, you know who the customer is because it's in the memo. But if you make like deposits, you won't know who the customer is if you just wait till it clears the bank typically. And then three, we're going to want to be able to group the transactions in our system as they go into the bank in the same format as they will clear the bank and show up on the bank statement on the bank side of the bookkeeping so that we can compare and contrast those two books, providing us a really good internal control called the bank reconciliation process. So that's going to be the idea. If we go into the sales receipt, it's going to look very similar to an invoice in the type of transaction. You'll recall the invoice was fairly complex. It does take a lot of information to set up so that the data input can be as easy as possible. So in other words, if you think about any place where you've gone to a store, you've brought something to the cash register, and you can have anybody up there that with some training can punch it into the cash register, collect your money, and be thinking about 20 other things at the same time. And that's in the data input is fairly easy at that point. However, in order to get it to that point, you have to set up your inventory items properly, your sales tax properly, your customers properly, and all that. We'll talk more about that when we start a new company file. And then we'll go through that process. Once it's set up, then the data input should be fairly easy. If you are in a standpoint where you're entering sales data, you want to not be thinking about 20 other things all the time, and possibly from time to time think about what the impact is of this transaction on the financial statements, and think about how you might set it up so that the data input could be as easy as possible. So if I go into the sales receipt, for example, we got this form. So this is another form which we might provide to the customer, may not provide to the customer, but like the invoice, we're going to give to the customer for sure, because we have to give it to them so that they will then pay us later. Here, this might be a receipt document that we provide at the same time, like a thank you letter or something like that, or the receipt of the transaction. So we've got the same information up top. We've got the ribbon at the top. Usually you go right into the sales receipt and enter the data into the sales receipt, but let's take a look at the ribbon. We got the main item. We got new. You could save it, delete it, create a copy. You can memorize it. We'll talk about that more later. Mark as pending. You can print it. So you might want to print it and provide it possibly. It's not required. You can email it. So it might be something that you would be emailing, although not as required as it would be with an invoice, which you would almost certainly be emailing out because you're getting paid at the same point in time that you generate this transaction. You can attach anything to it if you so choose. You can add time costs. These would be costs that would be generated through time and stuff. And we'll talk more about that in the future. And then we've got the formatting. You can preview it. You can check and adjust the templates. This is one area you might have different templates. You might use a charitable organization, might use like a form for a donation kind of template. And so you could adjust the templates here. We got the spelling. We've got the inserting of the new lines if we need to insert or delete lines that we had created on down below. Then we go to the send and ship. We got the email, the FedEx, UPS, and so on. We got the reports, quick report, transaction history. We got the process payment reports. This is that transaction journal, which is really good tool to see the accounting that is behind the data input forms. I highly recommend looking at that if you're trying to really get a good comprehension of what these forms are going to do to the financial statements. These are reports that we can then generate in the report centers as well. And then we got the payments. We got add credit card processing. I'm going to go back to the main page, and then I'm going to go back to a prior sales receipt. So here's a prior sales receipt. Here's going to be the customer. Now the customer, if you hit the drop down, we can choose a customer, or we can create a new customer as we go. So like with the invoice, we don't have to go up to the customer center in the home page to set up a new customer. If you're dealing with a situation where you're at a check register, for example, you might have new customers all the time, and you're entering, in essence, that you may enter then the new customer if you're in a system where you need that. Note that as you enter the customers, you may or may not want the information related to them. It's more likely that you would like to gather data from your customers if possible, so that you can get the contact information and so on and send them your newsletter and so on as you add more customers as you go. But you can add them in essence as you go. You also want to be careful that you're not entering duplicate customers and so on, so that you can track the information later, not only by what you sold, but by who you sold it to. And so then we got the class. We won't talk about that as much right now because it's going to be specific to a specific industry, like this is a job cost system. We have a whole thing on that we'll talk about in a separate section. The template that we're selecting, and then we've got the sales information. Now, same options as we saw with the payment item, where you can get payment, you could get paid in multiple different formats. These are generally going to be just a little bit different data input format, just for data input purposes. So cash, you got the cash here. You've got the check that could be received, the credit card, and the e-check in a similar format. We've got the date, and then we've got the sales number, which should generally populate automatically in a sequential kind of format. And then we've got the ship to, the check number. In this case, we have the check number because we chose the check format, meaning we're receiving a check, and therefore we're going to record the check number that we receive. I'm going to minimize this item to the left, and then we've got the item. So here's the tricky part. If you're in like a store or something and you're saying, okay, what's the item? This is the drop down that should make it easy. We got to set up the items properly in the same way as we saw with the invoice in order to make the data input as easy as possible. Remember, it's the same process that with the items, in that even if you do service items, you might be thinking like, maybe I'll just do an hourly service or something like that. You might want to try to break down the items to be a standardized set, like with the bookkeeping. Instead of just having an hourly rate, if you can, count the number of transactions or bill on some type of thing that gets you a group or package type of thing, it will maybe be easier for you to think about what your business structure will be and so on, and how many jobs you need, and be able to tell the client, this is exactly what I did for you. Here's the number of transactions, which could be a little bit more concrete feeling than simply an hourly rate and so on. So then you choose the item, and that'll populate the description. We'll talk about how to add the items later, the quantity, the rate, and then that's going to give the total amount. And then based on whether or not it is taxable, you're going to have a taxable item, and this is sales tax or usage tax in the United States. That's going to be a state and local type of tax. And then that's going to be calculated down below with our tax factor down below. Adding the tax gets us up to the 102.65. What's going to be the effect on the financial statements then? We're going to have an increase to this. This is going to go into undeposited funds this time, or actually they got it going up directly into the checking account. So it depends how you're going to set this up as to whether you want it going into undeposited funds or not. If you're getting cash, you might then have it going into undeposited funds first, and then basically grouping it so you could put it into the checking account. They got it going directly into the checking account here. So that's an option that you basically want to set up and think about how that's going to work, how the matching is going to work with regards to the amounts that are going into your checking account in QuickBooks versus how they'll be grouped in the bank statement. Do you need to take them in and out of this undeposited funds account? And so it's going to increase that. And then the other side is going to go to sales, but the sales is not going to go up by the 102.65 in this case, but rather simply by the 95, because that's the amount that we actually sold. The 7.65 is a tax, which in theory is not on us as the business owners, but to the customer. Therefore, we're not going to record the sale at 102.65 and then an expense with regards to the sales tax, but rather we're going to record our sales of 95, and then we're just the collection agent for the state, for the government, of the $7.65, and therefore it doesn't hit the income statement at all, but rather then is going to be a credit to a payable account, sales tax payable, which will then decrease in the sales tax payable and decrease in the cash account at a later point. Also note, like with the invoice, if this item was inventory, an inventory item, which this one is a non-inventory item, that if it was inventory, and that means we would be tracking inventory in the QuickBooks system, and therefore it would be decreasing the inventory, and in terms of the GL account as well as the sub account for the units that we would be tracking, the other side then being on the cost of goods sold, on the income statement and expense related to the inventory that we're sending. The inventory would not be for 95 or 102, it would be for whatever we purchased it for, which would not be on the sales receipt because we don't want to give that number to the customer. However, the system would know it from the item that we would set up. So just like when you buy stuff at the grocery store or something like that, you know, the cashier knows what the sales price is. They don't know what is going on with regards to the cost, right? Because that's good, but that cost is being done when you scan or check out the stuff by the system. So let's go then to the reports up top, and we're going to go to the transaction journal, into the transaction journal. This will give us that nice transaction so we can see it as we go. Highly recommend looking at the transaction journal to get a feel of what the accounts that are going to be affected, and then go to your financial statements and check it out further. So the checking account is going to be going up by that 102.65. Then we've got the materials account, which is an income account, which is going to be going, it's a negative here because they're reporting it in terms of debits and credits here. So it's going to be going up by the 95. You want to this could help you with kind of like the debit and credit concept. And then you've got the sales tax accounts, which these two are going to be sales tax for two different items, both go into the same sales tax account for these two sales tax items. It's a non-inventory item, therefore we don't have a decrease to inventory here because we're not tracking inventory in the system. We don't have cost of goods sold, which would be there if we were looking at inventory items. We'll look more at them in the second half of the course when we construct the inventory items there. Closing this out, let's go look at it on the financial statements now. Just before I do that, note that once you enter it here, if you entered it directly into the checking account, then it would go directly into the checking account. But you got to be careful of that because you want to match it up. If you got cash sales, oftentimes you would then be putting it into undeposited funds again, then grouping them together and depositing them. That number 2 in the deposit field represents items in undeposited funds, which would come from either the sales receipts or the received payments. Let's go to the balance sheet now. And when we collect on the sales receipts, that one, they had it going to the checking account, or it might be going to undeposited funds. So when you get the sales receipts, it could be going to either one of these accounts depending on how they set it up. That 95 we saw was in here. Actually, that's not the right 95. Let's go all the way down. I'm going to scroll all the way down. It was on like 1210, way down here. At the end, at 1210, it was like 102, that one that we were looking at. So it was on 1210. We're at the 102. Here it is. So we got it right here. It's a sales receipt type form that's going into here. So it's a deposit. It's going into the checking account, but we didn't take it through undeposited funds, and therefore it's not going in with a deposit form. We put it in there directly with a sales receipt form. If I double click on it, then that takes us to that sales receipt form that we were looking at, the full 102.65 then going in at that point, including the sales tax. The other side, if I close this out, you would naturally think would be going to the profit and loss report. So the other side going to the P&L report. It's going into income. So I'm going to look at the materials income, double clicking on the materials income. I'm going to try to find that same one. I'm going to go all the way down to 1210, down here where that one was, 1210 somewhere, and there's the 95. Notice it's not at the 102, the full amount. It doesn't include the sales tax. If I double click on it, there it is. That 765 isn't included in revenue. So we only recorded the 95 in revenue. Where's that difference of the 7.65 go? It goes in the sales tax, a liability that we have collected but is not our revenue, closing these two back out, and therefore it's going to be a liability that we owe in the future. Going back to the balance sheet to look that up, that's going to be in the other current assets somewhere, or I'm sorry, in the other current liabilities typically. The payable accounts, it's a type of payable account. There it is, sales tax payable. So there's the sales tax payable, and if we go back down to that 1210 item, then it's going to be these items here, I believe, are going to add up to it. So 7.36, if I double click on that, then it's that 7.36 plus the other one should get to that 7.65 because there were two entities that are collecting the tax. So it's going to be the sum of these two. If I collect both of those, they get to the same area. So then you would also have, if inventory was affected, a decrease in inventory. Closing this back out. If I go back to the balance sheet, inventory would be on the balance sheet, going back up to inventory. So if inventory were impacted, this inventory account would be going down. Double clicking on it, it would be going down here if there was a sales receipt with inventory. And then the other side would be going to cost of goods sold on the profit and loss report, which would be right here, the cost of the inventory we're selling. Back to the balance sheet. Just remember, if inventory is impacted, then we also have to deal with the fact that we could have a subledger. You could then check the subledger verifying the inventory accounts, which, for example, would be in the reports dropdown, inventory reports, inventory valuation summary report, this totaling up to the 30,683. We also need to track not only the dollar amount, but the units and types of inventory that we're tracking, that 30,683 matching out to the 30,683.38 on the balance sheet.